Nvidia shares under pressure despite posting better than anticipated second quarter earnings. Wall Street's lackluster reception to Nvidia's results stirring questions on the health of the AI boom. CFRA Research senior equity analyst Angelo Zino joins us now with more. Angelo, always great to speak with you to get clarity on what's going on in the broader tech space that you follow so closely. Is this sort of a sell the news event, or did it fundamentally change the narrative when it comes to the health of Nvidia as a company, not a stock story, but as a company story moving forward?
Yeah, no, so thanks for having me, Madison. And listen, I think more the former, right? So I think this is a situation where nothing's really kind of changed, more of the sell the news kind of event. And listen, at the end of the day, this is a company that beat their numbers, probably on the data center side, we call it about $1.5 billion or so. And then on the guidance side of things, also kind of guided a little bit above the street, but maybe not as good as it historically has done. A big reason for that, obviously, is because those sequential kind of gains at this point in time are definitely slowing. You're looking at about 15% sequential growth that we saw in the July quarter. I think that's expected to decelerate to about 8 to 10% here. Let's call it in the October quarter. So a big part of that is just the law of numbers in many respects. This is a company in terms of their revenue that has grown essentially 5x in the last 6 quarters. So that run rate is just absolutely phenomenal. We do think that, when you kind of look at how they're performing right now, specifically with the delayed Blackwell launch, that's even more impressive in our view, kind of with the momentum that we're seeing on both the H100 and the H200. And with the Blackwell launch that we expect, by the end of this year into early 2025, which will ramp, we actually see the potential for maybe even sequential growth to start to accelerate slightly from what we're seeing here in the current quarter, the October quarter.
Angelo, let me ask you, these big tech giants, Angelo, that are spending on AI, which is great news for Nvidia. I'm curious, do you see that continuing, Angelo? Any signs of a slowdown there?
So we see it continuing, just not at the pace that it has been, right? So in terms of kind of what we're looking at from kind of the biggest 5 spenders in the U.S. here in 2024, they're looking at about 35 to 40% growth. And next year, we think that decelerates closer to about 15 to 20% growth. And then I think what's more important now at this point in time is, given the questions about sustainability of kind of the NVIDIA momentum, is how does 2026 and even kind of go into 2027 look? In our view, at least as a placeholder right now, going into 2026 is about 5 to 10% CapEx growth. I think, a big question that investors have or a concern when it comes to NVIDIA, they kind of look at those kind of 70% declines that you've seen in the stock price. I think, 2 out of the last 6 years or what have you. A big reason for those declines actually is because back then, NVIDIA had a different complexion in terms of their revenue base. You're looking at about 50% or north of 50% of their revenue base tied to gaming. Now we're about 88% of their business tied to these hyperscalers, as well as kind of other data center type drivers out there. So a completely different complexion. But that said, there's clearly going to be risk looking ahead for this name.
Is that a bad thing, Angelo? I spoke with a guest yesterday who mentioned something about this, the idea that it's not a good thing for a couple of companies to be responsible for the majority of NVIDIA's revenue. Is that a negative catalyst for NVIDIA?
I think it depends on how you want to look at it, right? I'd actually personally rather be kind of tied to these hyperscalers than I would the consumer, to be honest with you. And a big reason for that is when you kind of look at the revenue trajectory of these hyperscalers over the last 2 decades, they're much healthier than the consumer themselves. So in many respects, I don't necessarily think it's a bad thing. I think it becomes a bad thing when you hit maybe a point where you're hitting spending levels that are unsustainable. But when you kind of look at these hyperscalers right now, in our view, in 2024 and even into 2025, these companies continue to grow free cash flow despite the fact that they're significantly increasing CapEx spend. And I think that's really important to note, because that continues to tell you that as long as these companies continue to have healthy end market trends, tied to the cloud, tied to digital ad spend, then it should bode well for them to continue to spend fairly, at a fairly healthy clip going forward.
Angelo, so all right, Nvidia's come and gone. After the bell today, we got another name reporting in your coverage universe, Marvell. I'm curious what you are looking for in that report, Angelo. Is that a name I want to own?
I mean, that's a name we've liked for a little while here. We do have a strong buy recommendation on the name, so it's a name we like a lot. Not necessarily for any given quarter, because who knows what is going to happen in any given quarter. But the good thing here is, finally, when you kind of look at their non-AI businesses, kind of their more kind of legacy type businesses in areas like carrier infrastructure, the consumer side of things. Those enterprise networking, those businesses have declined 50 to 70% over the last 2 to 3 quarters. Our view is kind of the inventory correction has kind of really played itself out at this point in time, and you're now looking at potential sequential improvement here in the July quarter, and more importantly, in the following 2 to 3 quarters. So we actually think they're at a point now where they're actually going to start seeing sequential acceleration because of the unwind we've seen essentially kind of play itself out on the legacy businesses.
And Angelo, we're also anticipating Broadcom earnings next week. What are you looking for?
As far as Broadcom is concerned, I mean, I think I think they continue to do very well. I mean, this is essentially a company at this point in time on the semiconductor side of things, really tied to kind of both the compute side of things in terms of their custom silicon business, tied to Apple, which we think is ordering very nicely ahead of this iPhone 16 cycle, and of course the networking business, which is kind of the bread and butter of their semiconductor business, and we think that is kind of running on all cylinders. So as far as kind of the semiconductor business, AI is driving that business very well, as well as Apple, and then the VMware side of things, they continue to exceed our expectations on both the cost-cutting side of things as well as kind of the revenue growth trajectory. And we don't see that changing at all as far as the numbers are concerned here for the July quarter.
And Angelo, it's had a heck of a run already. It's up more than 70% here over the past 12 months, Angelo, but you must still find valuation attractive at these levels.
I wouldn't necessarily say valuation is attractive at this point in time, Josh, but I will say this, we don't think they're egregious. So, we're kind of more in the camp of, at least with most of these kind of AI-driven names, you see some pronounced pullbacks out there. Those are where the buying opportunities are really to be found. So I wouldn't necessarily be chasing any of these names at this point in time, but the fundamentals still look really strong, especially for a name like Broadcom, we think kind of going into the print and going into 2025.
All right, not egregious. We'll take it, Angelo. Thank you as always for joining the show. Appreciate it.
All right, thanks for having me.